Let's talk about what are dark pool exchanges. A dark pool exchange, and he didn't even talk about this, but it's an off-the-exchange platform where institutions can trade without broadcasting their buying or selling intentions publicly.
Yeah, and I didn't know this, but exchanges, I mean, it makes sense. Exchanges and market makers, they make up nearly 87% of the daily trading volume. The other one is kind of made up, again, by these dark pool exchanges, that 13%. And these dark pool exchanges, they're trying to step in and do more of the trading. Obviously, to try and make more money, most likely.
Exactly.
But I believe this will leave the small investor in the dark, and they may not know what certain stocks are trading at. Because, again, this is kind of done behind the scenes, and it can be, again, dangerous. Anything that says dark, I'm like, whoa, I don't know about that.
Dark web, dark exchanges. You don't want to go there. It's dark. You don't.
Yeah, I like the light.
I like the light. I just see what's going on. I'll be poking around the dark there. Disappointed here. FINRA, another regulatory body, they seem to be okay with this. They'll be collecting fees from dark pools.
Oh, that makes sense.
Yeah, it makes sense, but it's terrible. I mean, now, one positive, fortunately for the past 2 years, the SEC has said, no, we're not approving this form of trading yet. But what worries me with the new administration and the new SEC chairman, he just seems to love the Wild West of trading. Like, sure, yeah, do crypto. Yeah, sure, do. Anything goes, laissez-faire, hands off. And that is terrible because I think the SEC will probably say, sure, dark trading, that's okay too. And it worries me because a little small investor, and again, that could be somebody with $1 million. Doesn't mean the guy that has $5. Yeah. I mean, we're small investors. We're talking people $100, $200 million. That's a small investor. They're going to get burnt by trying to play these games in Wall Street.
Well, and the issue I have here is, I again am not a big fan of regulations for the most part, but sometimes they're necessary. It's very similar, of course, to the financial crisis. Everything was going along fine until you started allowing for these loans that made absolutely no sense. And now you look back on it in hindsight and you're like, why did we allow that? Well, we just wanted to do hands off. Well, then, of course, people take advantage of that, and the little guy doesn't understand what's going on. They're like, oh, yeah, everything's going great. Well, Joe Smith over there, he's making all the money, so I'm going to do what he's doing, not understanding the full implications of what is going on behind the scenes. Then things blow up, and it's like, why didn't anybody tell me? And it's like, well, we didn't want to be a part of it. And I worry that this is kind of, I don't think we're going to have a 2008, 2009, but I think there's a lot of issues behind the scenes that people aren't fully accounting for that could cause problems, not today, tomorrow, but maybe 2, 3, 4, 5 years down the road. And, the thing that we look at from an investment standpoint is even though there's all this craziness going on, it doesn't really impact long-term investors. And especially with these dark pool exchanges, we don't really care if we miss out on a penny or two when we buy a stock. If we buy something for, I'm going to say $90 instead of $90, if we buy something for $90.05 instead of $90, it's not going to make an impact on our long-term investments. It's really going to be, again, the people that are doing multiple trades a day, they're the ones going to be impacted by this. So you just got to be careful.
Yeah, the small trader cannot compete with these guys because I don't think we put it in here, but it's like a millionth of a second is how fast they can trade. I mean, you have no chance. I think in our newsletter, I wrote, you bring a toothpick to a gunfight. I mean, you can't even compete with these guys, and they have so many things to do that trading. I mean, but again, if you're an investor, you buy something for 3 to 5 years, say, hey, it's a great company, let's buy it, collect the dividends, what it'll be 3 to 5 years. This all doesn't matter to you, but that's why we don't like trading. Also, too, this does seem to be adding more volatility to the markets, more volume, and this volatility, unfortunately, can scare investors out of good quality investments because they see the daily news, they say, oh my gosh, this is terrible, market's up and down, and it panics them, and then they sell good quality investments because they get scared because of all this craziness going on with the dark pools and all this. I'm very disappointed in Wall Street these days. The greed is just overwhelming.
And it's not necessarily Wall Street that's greedy.
Okay.
Wall Street's greedy, but the individual investor is very greedy as well. You tell somebody, hey, we make 8% per year. Oh, that's not that good. They want to be sucked into the hype and they want to make more money. And that is what scares me. And I was going to go back to this conversation real quick I had with the gentleman that we were talking about, cryptocurrencies and everything. And I was saying, the thing that I have an issue with is people don't understand what they own. He's like, well, it's the same with stocks. I'm like, that's the problem. People don't care about actually understanding what they own at the end of the day. They only care about what it's done over the last few days, few weeks, few months, and that's what's causing them to buy. And that is what creates bubbles. That is what I think could cause a lot of people here to lose a lot of money. And I think we are in the middle of, I'm going to say a bubble. I don't see how we're not based off the valuations across all these different asset classes.
There will be something that happens, I would say, in the next 12 months that it's going to be very frightening for people. And again, if you've got good quality investments, you own a good company, good strong balance sheet, good income, good cash flow, you'll be fine. Don't be sold out of it. But there's going to be something that's going to happen because this froth, again, 87, I saw that happen in 87. I saw it happen, the tech boom and bust. The Great Recession was more real estate. I mean, it's just, things don't go on with this craziness, and it's very disappointing. I've been doing this for over 40 years. It really disappoints me.
Got to get moving on here. But the other thing that I heard this last week on CBC was this gentleman said, well, it's not that valuations cause the bubble to pop. So I still think there's more room ahead. He said there has to be a catalyst for the bubble to pop. That's absolutely true. But the problem is the more the bubble inflates, when that catalyst comes along, the larger that pop is.
Yeah.
And that's what concerns me is instead of maybe falling 50%, you might fall 80% on something because it got so overinflated.
And then people say, stocks are so risky. No, it's a silly thing. Stocks are not risky if you do the right things.